This case study deals with corporate restructuring of various entities which are owning shares in an Indian company, and there is a merger or a demerger outside India which results in transfer of shares of an Indian company. So you're given that Sunio Japan is a global company which has subsidiary in various countries. 5 of its subsidiaries hold 100% share capital of Sunio India, which were acquired by them at various costs over the years. The group undertook corporate restructuring in 2018-19, wherein certain group reorganizations were carried out. The relevant details are as under. Now, if you remember, there are certain sections. Let's say you have Sunio Japan, then you have various subsidiaries, 5 of them actually, and these 5 subsidiaries together own Indian company. Now, there are corporate restructuring whereby one of these entity is merged into other. There are some demergers happening. If you remember, there's a set of provisions under the Income Tax Act in section 47, which deals with a case where there is a merger of a foreign company with another foreign company, which results in transfer of shares of an Indian entity. Similarly, there could be demerger of division of a foreign company, which may result in transfer of shares of an Indian company. Now, under section 47, such transfers are normally considered as exempt from tax, provided certain conditions are satisfied. In this question, you need to look at those conditions to see if the exemption will be available. So entity, the name of the entity, all entities are wholly owned subsidiary of Sunio Japan, except Sunio Malaysia, which is wholly owned subsidiary of Sunio China. So you have SJ, you have a wholly owned subsidiary of SJ, which is S China, and this China is owning S Malaysia. Other entities are all wholly owned subsidiary of Sunio Japan. So now in case of Sunio China, the cost of acquisition of shares of Sunio India were 50. It was merged with Sunio Pty Singapore. So you have another subsidiary, Sunio Singapore. Sunio China merged with Sunio Singapore. So in other words, there is a merger of one foreign company with another foreign company. Now you are told that the tax status of such transaction in local jurisdiction, which is China, is it is exempt from tax, and it is also exempt from tax in Japan. Now, if we look at this particular case, there is a merger of one foreign company into another foreign company, by virtue of which there is a share transfer of an Indian company. Such a transfer is exempt from tax, provided certain conditions are satisfied. And what are those conditions? The first condition is at least 25% of the shareholders of the company which is merged should continue to remain the shareholders of the transferee company. In this case, the merged company, the company which is merging is SC, Sunio China, and it is merging into Sunio Singapore. The shareholder of both these companies is Sunio Japan. Therefore, 100% shareholders of the transferor company are also the shareholders of the transferee company. Therefore, this condition is satisfied. The second condition is that such transfer should be exempt in the home jurisdiction. Now, if you look at it, both in China as well as Japan, you have been told that such a transfer is exempt from tax. Therefore, on merger of Sunio China into Sunio Singapore, the transfer of shares of an Indian company, Sunio India, will be exempt from tax. The second is Sunio Pty Singapore, this entity. It had a cost of acquisition of 60 and it demerged the division containing shares of Sunio India to Sunio USA. So this entity actually demerged a division to Sunio USA, and in the process of demerger, it transferred the shares of the Indian company. That in such case, again, 25% of shareholders of Sunio Singapore should also become shareholder in Sunio USA. In this case, we have been told that all these companies except this are wholly owned subsidiary of Sunio Japan, which means that 100% shareholders of Sunio Singapore and Sunio USA are same. So this condition is satisfied. The second is such transfer should be exempt in the country of the transferor, which is Singapore. You have been given that this transaction is exempt from tax in Singapore, which means even the second condition is satisfied. Therefore, the transfer of shares of an Indian company by Sunio Singapore to Sunio USA will be exempt from tax. The third entity is Sunio Malaysia. Now, you had Sunio China, which was owning Sunio Malaysia. You are given that the substantial value of Sunio Malaysia is from India. Now, Sunio China actually got merged with Sunio Singapore. In the process of this merger, the shares of Sunio Malaysia were transferred to Sunio Pty Singapore. Right? Now, you're not specifically given that how this transfer has happened, but this is something you need to figure out from these two, first and third point. That the shares were transferred because this entity was merged into Singapore. So the question is whether transfer of shares of a foreign company which derives its value substantially from India under a scheme of merger of two foreign companies will be taxable in India or not. Now you are told that the tax status of such transaction is that they are taxable in Malaysia and China. So they are taxable in Malaysia and they are taxable in China. So how would the taxation work for this particular case? Let's just see that. Now in this particular case, what is going to happen is that transfer of shares of Sunio Malaysia, which is a subsidiary of Sunio China, to Sunio Pty in scheme of merger would result in transfer of Sunio India held by Sunio Malaysia. This would be an indirect transfer. Section 47(6)(ab) provides that any transfer of a capital asset being share of a foreign company which derives directly or indirectly its substantial value from the share or shares of an Indian company which are held by amalgamating foreign company. So if there is a foreign company, it derives its value principally from India, and there is a transfer of shares of such company by reason of amalgamation of a foreign company which is Sunio China to the amalgamated company which is Sunio Singapore. In a scheme of amalgamation shall not be regarded as transfer provided the following conditions are satisfied. At least 25% of the shareholders of the amalgamating foreign company must continue to remain the shareholders of the amalgamated foreign company. So in this case, because both of them are subsidiary of Sunio Japan, so this condition is satisfied. Such transfer should not attract capital gain in the country in which the amalgamating company is incorporated. So there should be no capital gain in Sunio China, but you are given that this transaction is taxable in China. Since this second condition is not met, this transaction will be liable to tax in India. Aman, a non-resident for Indian tax purpose, bought global depository receipt of an Indian company, MNO Limited, which were issued in accordance with the notified scheme of the central government in foreign currency. During financial year 2018-19, he sold part of GDRs to an eligible non-resident outside India and remaining to Mr. Chaman, a resident and ordinary resident. Compute the capital gain tax on such sale. So you have a NRI who bought certain GDRs of an Indian company. He sold such GDRs to two people. One, a person who is a non-resident and an eligible person. The second is a resident and ordinary resident, and he had certain capital gains. The question is, are such capital gains liable to tax in India? Now, under the Income Tax Act provision, transfer of GDRs of an Indian company, where such a transfer takes place to another non-resident who is eligible to purchase them, is not liable to tax in India. Therefore, the capital gain which arises to Aman on sale of GDR purchased in foreign currency to an eligible non-resident will not be liable to tax in India. However, when there is a capital gain which arises on account of transfer of GDR to a resident and ordinary resident, that is liable to be taxed in India at the rate of 10% without any benefit of indexation. Therefore, in this particular case, capital gains arising on sale of GDRs to Chaman would be liable to tax in India.